Hi everyone. So today I want to talk to you guys about how we value inventory. Now, there's two major parts of this topic. One is looking at period costs and product costs, whether we apply an expense across an entire period or whether we apply it specifically to individual products that we sell. And the other part of that is when we find out that stock might be damaged or we might not get the amount of money that we hope for. If something becomes outdated or it becomes scratched or anything like that, are we still going to get the sale price that we think we're going to get? And what happens in that situation? So the first thing I want to look at, I'm going to give you some examples about product cost versus period cost. And in this example, we're going to look at a bike. So with this example, I'll be talking about applying a modification and how that can affect the product itself and also our profit at the end of the day. After that, we're going to jump into the slideshow and we're going to look at how these write-downs and things like that can end up impacting the business and what we do in those situations when it comes to our ledgers, our journals, and our stock cards or our inventory cards. Okay? So let's jump in. So there's going to be times where we have inventory that isn't entirely standard, or we've paid more than just the cost of inventory to get it in. In situations like that, it's important that we need to look at what's relevant. So we have this idea of what we call the relevance test and deciding whether or not a cost is going to be relevant to the business. There's a couple of really good examples around the idea of paying for shipment in the textbook, and I really suggest you have a read of those. The first example is where someone is paying $300 for an item that they're going to sell, and it has a delivery fee of $10. Now, because that $10 is applied to one item, it's pretty significant, and what they've done is they've applied that as cartage inwards, and they have added that to the cost of the item. But there's another example where they've paid $10 for shipping and they've gotten 10 items. So you're applying $1 per item, and that's not necessarily a relevant thing to do, especially when you're doing it across hundreds of individual items. So it's important to consider that. The other example is where you have modified stock in some way. I might have a bike that I've purchased for $150, and this is primarily what I sell. But then on top of that, I might apply my own labeling to it. I might do a modification to it of some kind, and that modification might cost me, say, $20 per bike. Now the question is, if I'm paying $20 per bicycle, am I going to just leave it as an extra expense? Or am I going to apply it as part of the cost of my inventory? And the reason this is important is that this can alter the expenses that you have at the end of the period. If you just apply it as a period cost, all of it is expensed in one go. Sorry, that was my phone. All of it is expensed in one go. But if you apply it as a product cost, then what occurs is you're only expensing the amount that you sell. And this can make a difference of hundreds and hundreds and hundreds of dollars on profit for a small business and millions for a larger business. So it's important to keep that in mind. Are you going to have a piece of inventory cost $170 and say have 100 units on hand, which means that the total cost of your inventory is going to be $17,000? Or are you going to have your inventory cost $15,000? Okay. Now, at the end of the period, if I've sold half the bikes, with this price, my cost of sales is going to be half of this. So it will be 8,500. Okay. With this, it'll be 7,500. Okay. Then considering the modifications. If we apply it as a period cost, that $2,000 is applied across everything. Okay? And that reduces our profit. But up here, that's our total expense. So we end up having a difference of $1,000. Okay? Our end of period profit has actually been altered by this choice. So it's important to consider these things. As I said, there's no one right way to do it. It's about what is the right choice for your business at the time. So now let's take a look at how we value our inventory when sometimes we think that we won't get the selling price that we thought we would. At times, we're going to be offering discounts. So inventory is usually valued at its cost price, but sometimes management is going to sell below cost price. It's not a good situation, but it does happen. Okay? So in some industries, management will sell a few items below cost as a marketing strategy. The idea that you will, as a customer, come in, look at these really cheap items, buy those, and then on your way out, buy something that's a little bit more expensive. So it might also happen because it's been shop soiled. So it might have been a test product that people have handled. It might be damaged. It might be near its use by date. It might be superseded by a newer model. So as an example, when I got my iPhone, 2 months later, a brand new iPhone came out. It happens. And sometimes technology becomes obsolete as well. Now, this is where we come up with the idea of net realizable value. So it's the total amount of value that we think we'll actually be able to get from our inventory. So strict definition that you need to write down: the estimated selling price of an item less any costs incurred in the selling, marketing, or distribution of that item. So I've got an example there, but when we're thinking about costs that we might apply, this could be shipping costs. It could be commissions that we pay to people selling it. It could be a whole host of things, but usually they'll be very specifically mentioned within the question. But for now, let's look at a Bluetooth speaker. And let's say that the cost price of it is $150 and the selling price is $250. And we normally pay a commission to staff of 10%. So in this case, we can calculate our net realizable value as our selling price, $250, minus the commission that we pay, which equals $225. Now, obviously, this is well above the cost price. And in situations like this, when we're comparing cost price and our net realizable value, we usually always apply the lowest value. So normally, that's cost price. It's what we pay to our suppliers. But net realizable value is only used if it's expected that it will actually be less than the cost price. So this is another rule that I'd like you to write down. Inventory is valued at the lower of cost and net realizable value. Okay? It's in situations where net realizable value is lower than our cost price that we actually make some adjustments. So let's consider this Bluetooth speaker again, where we had our cost price of $150, our selling price of $250, and a commission of 10%. And we've got 100 units on hand. Now let's consider that all of a sudden a new range of speakers is being released. Obviously, the speakers that we have, they're not going to be as valuable as they once were. So management decides that they're going to drop the selling price to $150, and that's it. Just $150 flat. They want to clear the shelves for the new model, and they want those speakers gone as quickly as possible. In this situation, our new selling price is 150. But once we minus our 10% commission, which is now going to be $15, our net realizable value is $135, which means all of a sudden we've gone from having a cost price of 150 and now we need to value it at our net realizable value. So let's look at how we do that. So we have the cost price of one speaker, net realizable value. The difference is $15. We need to remove this value from each item of stock. And across 100 items of stock, that $15 is going to become $1,500. So just keep that in mind. We're going to apply the rule of the lower of cost or net realizable value. And we need to create an expense because we are having an outflow of economic benefit. We are reducing our assets by $1,500. Now the general journal entry is going to look like this. Inventory write-down is our expense. And what's the asset that it's reducing? Well, it's inventory. Now, when you put in your narration, this will be a longer narration. You need to include your document number, which will be a memo, and you'll need to say adjusting entry for inventory write-down. You don't necessarily need to include all this information about what the item was. Now, we classify this as an expense account. It's going to be reported in the income statement between gross profit and adjusted gross profit, but we will be looking at that more in the future, so don't stress about that too much at this stage. Now, this doesn't just occur within the general journal and hence the general ledger. It also occurs within our inventory card, because if you've got inventory that's valued at $150 in your inventory card, and all of a sudden it's valued at something different, you need to make sure that that's actually apparent. And we consider that an out entry, and we do it like this, where we have across each of the 100 units, we are reducing value by $15, hence the $1,500, and you can see our final amount there is $13,500. Okay. So just as a note, the cost price of the Bluetooth speaker is no longer shown on the inventory card. It has disappeared. That's because we have applied the rule, and because we've got the document number there, it all links back. It's pretty straightforward. When people come and look at your inventory cards, they can go, okay, there's been a change here. I'll look for this memo. They'll see what's occurred, gives full details. Okay. So, in wrapping up, I'll just make sure, because this is a special situation leading into the holidays, please make sure that you have your notes done by Wednesday. I want to make sure that everyone has a really good grasp on this topic, or at least knows what they're struggling with before the holidays. Okay? So, have your summary of what you've learnt, and then you need to go on with the questions. So, let's wrap this up. So this is the final topic that we're looking at before the holidays and before your SAC. It is a pretty straightforward topic, but what you'll find is that within questions, they'll throw a lot of red herrings at you. They'll throw a lot of figures that won't mean anything. So things that won't necessarily affect the net realizable value, things that won't be considered product or period costs, and you need to be able to spot those out. So it's really important that you have the notes done by Wednesday's class, so we can jump into these questions and we can really figure out where the traps will be, so you'll be ready for your SAC. Okay? Other than that, I'll leave you with the wrap up of what questions need to be done, and of course, I'm going to leave you with what I think is absolutely the best meme that I've seen in such a long time. Yes, it's Ren's FIFO one. So have a good day, guys, and I'll catch you soon. Bye.